So welcome everybody. Glad you could join us today. It's been about a year since our last FIF. There was a simpler time before a global pandemic changed the world that we live in. Prior to FIF 2019, we hired FMI, a leading research and consulting firm in engineering construction, to do a study and prognosticate what the next 5 to 10 years were going to look like in the finishing trades. I'm sure you all remember Mike Clancy. He did an outstanding job of presenting their findings at FIF. And then 2020 reared its ugly head, and some new information has come to light. So Mike and his team at FMI updated the study for us, and in light of the new information, they're here with us today to present those updated findings. So I'll turn it over to Mike. I appreciate everyone joining in, and Mike, I appreciate you and your team. Thank you.
Thank you, Anton. One thing I want to say before we get started, if you have questions as we're proceeding through our time today, just go ahead and drop those in the chat. If I get a chance to answer them during the presentation, I'll do so, but otherwise we'll try and answer as many of those as possible at the end of the session. And appreciate the welcome, Anton. You know, it is amazing the difference a year makes. I think it was just about exactly this time last year that I was rolling up on the stage at Finishing First with my sprained ankle in my little hover round scooter there, and the world hasn't got any easier or smoother since then. So just as a reminder, you know, this was all about identifying what was next for the industry, and especially the union finishing trades industry over the next 5 to 10 years. And so the methodology behind this was heavily survey and interview based, and then involving some of our FMI researchers and to use Anton's word, prognosticators, to think about what the next 5 to 10 years look like. And so, you know, some of the factors that we thought were going to drive change in the industry were around just changing market structure, some of the economic conditions, technology, the ongoing challenges around skilled labor shortages, and then just some sort of new things we're seeing from the standpoint of a drive towards increased energy efficiency, new sort of alternative procurement of construction projects, which is having a huge and disruptive impact on the industry. And then just any sort of industry consolidation that we'd expect to see that goes through certain, you know, the industry goes through those consolidation cycles. And you know, we sort of opened up last time with an expectation that a recession was sort of around the corner, right? That an industry downturn would be coming in the first or second quarter of 2020. And I have never been so disappointed to be right as I was at that time. But our CEO, Chris Daum, one of the sort of advice or sort of statements he gave to our clients was, you know, think through the downturns of the past. What choices did you make? What did you get right? What did you get wrong? Or what actions did you fail to take soon enough? And that was the fundamental question that we kind of posed to everybody going into this. Are there things that you wish you had done sooner last time around, and should you be doing those things today? And so one of the things that we were very confident about going into, you know, coming out of the Finishing First conference was that we were likely to see an industry slowdown. So, you know, in December 2019, here's some of the stuff that we believed was important. So we saw the likelihood of trade wars, right? We saw a lot of tough talk on trade from this administration, some saber rattling by China, by some other countries around the world, just sort of a general rockiness in the global economy. So this was, Brexit was still a big item of news and hadn't really, well, and it's still a big item of news, right? Britain hasn't actually exited yet, even a year later. But there was a lot of uncertainty around that and just around kind of China's economy slowing. The stock market in the US, though, was at all-time highs. But what we started to see was consumer sentiment starting to waver. So you can see here some of the signals that we were watching. And this comes right out of the 2019 presentation at Finishing First, right? Unemployment was looking really good, near a 50-year low. just a few months before finishing first. Personal consumption was up, but consumer confidence was starting to tip and down. And so that was one of the things that to us presaged a recession. Inflation being below 2% and low energy prices, good for consumers, somewhat bad for, particularly for folks here where I live in Houston, but somewhat bad for producers and things like that. But what we were starting to see was the economic growth of the past few years kind of bottoming out, slowing down to about 2% plus or minus. And that was really driven by large purchases sort of falling, whether those were by consumers on things like automobiles, or whether they were by business in terms of investments. And so the manufacturing index slipping as well, and residential starts slowing. All of those pointed at that time to another recession coming soon, and non-residential building kind of falling off in 2020 or 2021. At the same time, we were looking forward to probably not with joy and anticipation, but with trepidation to a very challenging and interesting election cycle that was coming in November of 2020. Obviously, that was going to have some impact and some challenges on sort of regulatory environment, the economy, and the like. We expected continued intervention by the Fed, continued rates being pushed down, and just generally kind of a really sort of sluggish GDP growth moving towards that recession. And then, sort of what sums up my thoughts about 2020 is this meme from The Office with, what year is it from a time traveler, and them realizing that they're in 2020. And having that kind of stress and heartache. And this sort of sums up, I think, a lot of our feelings about this year. If we could skip one, this would have probably been one we'd have skipped, barring, some personal triumphs during the course of the year. This has been a really tough year for a lot of folks. And in fact, our forecast for the first time ever, this was our second quarter outlook, where we forecast work put in place. For the first time in my 13 years at FMI, and really in the history of anything that I've seen, every single market, every single segment was projected to be down. And this was, a really tough spot to be in, to have these conversations that said, nothing is going to be a good market. There's not going to be any place to spend your time. Now, think about where we were in the second quarter of 2020 when this forecast came out. We were still early days of the pandemic, right? If you think about when it really kind of kicked off here in the U.S., I can peg it at about mid-March. I was at the National AGC Convention and Con Expo in Las Vegas again, and that was when things started to go sideways and people started to sort of drop off. And so, this was not something we could have predicted then, but it started with these ideas of shutdowns and things like that have a huge impact on the demand for construction. And in many states, construction was not immediately viewed as a necessary or an essential business. And so certainly in the Northeast, there was a pretty big hit to a lot of our businesses. Now, things started to turn by the third quarter. And so again, thinking about where we were before all of this started, and all the things that were going on, all the heightened uncertainty around trade and around consumer sentiment and around an upcoming presidential and congressional election. And now throw on in the first and second quarters of 2020, a global pandemic. Add on societal unrest and upheaval around issues of racial justice that caused a lot of tension in certain parts of the country. Add on this inability to plan, invest, or forecast, because at its core, we're a consumer-based economy that shut down almost all consumer activity. And so what we found is this created kind of the most unique recession in U.S. history. For the first time ever, the economy just dropped like a rock. And frankly, for all of the faults of the outgoing administration and their sort of how they've handled it, one thing that did work well was the dramatic actions taken by the Federal Reserve and by both parties in Washington on the first round of stimulus, taking dramatic actions to keep the economy moving. Our ability to do that was certainly enhanced by the U.S.'s position as sort of the global currency of choice. We were able to do that with a much lower cost of debt service than any of the other developed economies that undertook similar stimulus. And so I think that's something positive we can take away from this. Also just the fact that we were able to keep our economy away from negative interest rates, which are extremely punitive to savers. And we are actually seeing in a lot of European countries, all of this kind of has helped. Now, what were we dealing with? So unemployment, even this is the third quarter, but even, sort of during that whole quarantine shutdown period was at 10 to 15%, almost 20% in some geographies. These are levels that were seen sort of during the Great Recession of 2008 and 9, and before that, the Great Depression of the 1940s, but not ever apart from those two times. And it's never been so immediate. The economy has never shut off like a faucet before, and that was wildly disruptive. Especially personal consumption being down. Think about how much personal consumption is really service spending, right? It's spending in restaurants, hair salons, massage and spa places. It's spending on travel, all of which dried up overnight. Business investment was down overnight. Government spending went up, and consumer spending on goods went up, but how they spend on goods became very different, right? A lot more online or curbside pickup purchases. All of these things have had a huge impact on the underlying economic signals. Interestingly, the housing market has continued to show strength. There's been a lot of sort of anecdotal discussion of people wanting to buy or improve their homes during this quarantine time to improve their personal situation, their work from home situation if they're working from home. But that has a limit to it. And so by the time our last forecast came out, which was just about a month and a half or so ago, unemployment was down from the peak, but still very high at 8.4%. Inflation had fallen to negative levels, largely driven by low energy prices, but also, sort of panic pricing on durable goods like vehicles and things like that, which actually temporarily juiced spending on those items and sort of drove some consumer spending there. But the economy overall declining at a greater than 5% rate annualized. Consumer confidence down 20% compared to last year. And so, we're starting to see some slight improvements, but, they're really very, very mixed and very glum, and it still looks pretty rough. A lot's going to depend on kind of the regulatory environment going forward. But one of the positive things has been the construction industry. It's been surprisingly positive, actually. So I showed you, our second quarter forecast where every single market segment was in the down category. Well, now in our third quarter forecast, just 3 months later, we projected that the total engineering and construction spending for the U.S. will end the year about flat or maybe less than a point below 2020. So, coming off slowing growth, 2019 had slowed down to about 2% growth. 2020 looked like it was going to fall off the cliff and be down 10% or more. But what we're finding is, as construction has been identified as an essential industry in most places, as people have had the opportunity to do more work, and as we're starting to get a little bit more used to operating in this post-pandemic world, we're starting to see some markets recover. And in fact, we've got a couple markets that have been up. As I mentioned, improvements. This is really residential improvements, people spending money fixing up their place. But also public safety spending has grown. This is usually a growing market in a recession. You think of public safety, the biggest driver of that is prison construction, and prison construction is sort of inversely related to the economy. The worse the economy gets, the more crime gets committed, the more prison space is needed. So that's moved into the growth market, but so many segments have moved into what we call stable, which is really, it's growing, but it's slow growing, right? It's flat to about 4% growth. And that's included not just single family and multifamily, but things like healthcare and transportation and communication, and even some of the infrastructure markets that really we thought were going to have fallen off the cliff. And really the only losing markets that we believe will be down to end the year are sort of the non-residential building construction markets, the non-residential, non-institutional building market. So things like lodging. Lodging is apt to be a crippled market for 5 years. If you look at some of the RevPAR and the and sort of the room rental rates, most hotels are operating at 10% occupancy or below on average. It's just unsustainable. So we would expect lodging to be clobbered for years. Office is another one that I think we've just, because so much of work, of office work is being virtualized, and I'm speaking to you from my lovely home office myself, the need for office space has really diminished. In fact, in my Houston, we still hold our downtown Houston office space, but we're the only company on our floor now. The 20th floor is only 25% occupied. And then some of these other markets, commercial has really been battered by impacts to mall capacity, to people not wanting to go into retail and spend. And frankly, the only part of commercial that's really good is last mile distribution right now for groceries, for the Amazons of the world and things like that. Educational, there's going to be a lot of impact to that, and we'll talk about that in a bit. Religious, in most places, churches were shut for months. It's very difficult to justify a new building when you have to have significant capacity restrictions on the existing one. Amusement and recreation, this is things like casinos, amphitheaters, sports venues. That's another market that until we really wrap our head around living in a post-pandemic world, and honestly, we get a COVID vaccine that works, that's not going to be the be all and end all of this, because I think we've come to the awakening and the realization that the next pandemic could be 50 years from now, or it could be 5 years from now, or it could be 5 months from now. And so the need to think about how we change the way we build things, how we change the way we congregate, how we change the way we live to be a little bit more resilient to those kinds of events is something that we're just now starting to get through. So all of these, I think, were, this was some definitely a clearer and prettier picture last quarter than it was 2 quarters ago. We expect this to maintain relatively consistently in our fourth quarter forecast, although that's still another week or so away from being delivered. One of the things that we look at is, kind of the broad divisions between residential, non-residential building, and non-building construction. Interestingly, unlike every previous recession, the residential market did not lead us into this recession. We usually see that sort of lead us into a recession, but this one was different, right? This one was because the entire gross domestic product of the U.S. fell off a cliff. In March, the economy just changed at an extreme pace. Started just one of the most severe and hopefully one of the shortest recessions in U.S. history. We're really looking forward and expecting a quick return to GDP growth, essentially ending the downturn. But we don't think we're going to return to where things were until 2022 or later. So we anticipate 2021, you can see there being a year of really nice growth, right? We're projecting between 4.5% and 7% growth in gross domestic product during 2021. But because we fell so far in the second quarter of 2020, we do expect that it's going to be a couple of years before we claw back up to where we were. Recent jobs reports kind of confirm this, says that we're not really out of the weeds yet. And there's lots of bankruptcies and kind of labor issues ahead around, institutions and small businesses, corporate debt, what the government does with stimulus and tax policy, et cetera. So all of those are things that are still unanalyzed or that we don't have full clarity about. But really, the virus, the consumer, the employer will all determine the recovery, right? And so, one of the things that we continue to circle back to and remind ourselves of is consumer spending is about 2/3 of the U.S. economy, and so the consumer is going to drive economic growth. Strong consumer base is vital. And then business and government spending are closely split as the remainder. And so when business spending slows down, the federal government can sometimes step in and supplement and provide stimulus. But in this case, it's the consumer spending that really fell off the cliff. And there's just no government spending program big enough to overcome that, right? So as the virus gets under control and hopefully with new vaccines coming out in the next very short period, it looks like, as well as hopefully some policy that kind of maximizes people's ability to operate in a healthy way. Personal consumption, which is mostly dependent on services, is going to need to come back, and as that comes back, we'll see the overall economic picture start to improve. The other thing that's interesting here is just sort of the indices and how they're doing. Again, that the housing sentiment index, despite kind of plunging during the depths of the initial shutdowns, has really spiked back. People have a pretty good sentiment about housing. And also in manufacturing, we're starting to see that index rise again as people are expecting some manufacturing to return to the U.S. That is potentially one of the bright spots coming out of this whole pandemic and shutdown period, is a recognition of the fragility of our supply chain and the need to be really thoughtful about supply chain resilience and about manufacturing more in the U.S. And so, certainly some reasons for cautious optimism, some reasons for hope. We do think that there's some opportunity to see things continue to improve here. The residential activity has been really mixed by metro, and this is something that I think is tied to both the pandemic and to some of the protests and upheaval and that sort of stuff that was going on. What we found is that this may lead to the long anticipated flight from the cities, right? Particularly, you look here in the upper right quadrant, that active listings in San Francisco County. A couple thousand homes for sale in a market that generally stays around 1,000 or so. Just a huge spike in availability and of people leaving that metro area in ways that they hadn't before. And you can kind of see where they're going, right? In the most case, they're going to places like Salt Lake City or like Dallas, where the population density and cost of living is much lower. This was something we talked about in our initial report, was the impact of high cost of living in urban areas, and particularly in areas where that are areas of strong union density, but where our workers have to live hours away from where they work because of just the high cost and unavailability of housing. Well, what we're seeing is places like San Francisco, places like Chicago, we're seeing sort of an out-migration. Places like New York City, of all places, where we're seeing substantial out-migration. That's either going to do one of two things. It's either going to force some changes in policy that make those places a little more affordable, that make housing a little more affordable there, that make it a little more friendly to the average sort of individual to operate and to live there, or it's going to lead to some of the urban blight that we saw coming out of the Rust Belt based on the sort of 1970s and 1980s challenges that were happening there. So hopefully we get the policy prescription right this time and address that. But what we're seeing is, particularly in these large, expensive metro areas, a lot of out-migration. And that's driven by a few things, right? It's not just driven by cost of living, But half the fun of living in a place in New York City is being able to do all the stuff that you can only do in New York City. And now you can't do any of that, right? Broadway's closed till the end of May. Restaurants are at, restaurants may be closed again, but if they're not, they're at 25% capacity. People want to live in New York or San Francisco, particularly younger people, because it's a hip place to live with a lot going on. And when you're trapped inside your house working from home, it frankly doesn't matter if you're working from home in San Francisco or you're working from home in Columbus, Ohio. And what your money gets you in San Francisco versus Columbus, Ohio is really very different. And so that's something that our researchers dug into, because it's an area of interest, is what's this going to do long term to sort of migration patterns and where people are going to choose to live. So just to kind of refresh your memory from last year, the outcomes of this study, we identified factors and potential scenarios that we believed would define the finishing trades industry and the built environment over the course of the next 10 years, and try to project the potential future state of the industry. That was the goal in this. And so we identified and shared it at Finishing First last year some cornerstone topics, and within those cornerstone topics, some influencing factors that we thought were most likely to be critical in their importance. And if you look on the economic, impending recession and investment in infrastructure, we thought were going to be huge influencing factors of changes in the industry. Rapid technology changes, digitalization of workflow, and prefab and modularization, we thought from the technological standpoint would be huge. And then in the workforce standpoint, we said, certainly the shortage of skilled workers continues. Certainly the trend of promoting trades in education, loss of share to non-union and declining union membership were all key trends and key influencing factors that we wanted to stay on top of in terms of their impact on the industry overall. And the question is, have any of those changed? Have any of those stopped or diminished in their importance? The question for us, that as Anton and the folks at Finishing First reached out to us, was, does the picture really change all that much based on what we've seen? And our answer is, we think all of this stuff is still really important, but we also think there's some new trends that will also impact the future of the industry. So from an economic standpoint, this urban flight idea, and really there's 4 or 5 metros where that's really kind of playing out. A return of manufacturing, we think, will be a real positive opportunity, right? And I do think that there needs to be a push in infrastructure, right? So we'll talk sort of at a high level about the stimulus plans that are out there. Obviously, nothing got done because of politics, but it is fairly likely that something will get done under the next administration. From a technological standpoint, the things that we thought were important remain important. But something that's really different is this broader and sort of deeper split between the professions and the trades, or between project management and the field. Many of my clients, they're craftspeople in the field, their foremen, their superintendents, they still showed up every day out in the field and had to work. And their project managers and estimators and executives were all working from home. And for those of us who are doing a lot more work from home, that's a different dynamic. And so, really the understanding that the work will continue, but technology will facilitate it. And then really prefabrication continues to be important and interesting to the industry. But now, in addition to doing it for purposes of cost reduction or improved quality by manufacturing off-site, there's an efficiency and a social distancing, right? We're having to run smaller crews. And so the ability to send things out that are largely completed and finishing the job, that's a huge change as well. The workforce trends that, and again, these all fall in those same buckets, but the new workforce trends that we think are likely to be important, smaller crews and a return to shift work. In the construction industry, in most cases, we've kind of gotten away from shift work over the last several decades. With the exception of big mega projects or shutdown work or industrial work, there's not usually a second shift. Well, because of the need for social distancing and the need to provide more space per worker to reduce the spread of infection, we're seeing those smaller crews and more shift work. The other thing that I think is a unique and exciting opportunity for the building trades in general and the finishing trades in particular is the college experience is no more, right? And so one of the challenges that we've had for the last 3 decades in attracting young people into the trades is this push that every American needs to go to college. And I, we can debate that to the end of time. I think every American needs to be a lifelong learner and needs to have an education beyond high school. But I think, a post-secondary trades education should have been all along highlighted as a viable option alongside college. Well, now, young people who maybe were going to college more for the college experience than for any sort of career field that they needed a degree for, it's not going to be really attractive to take on $150,000 of student loan debt to do college from your parents' basement. And so, what will be really interesting, we're already seeing this a growth in gap years as young people take time off from college to be in the workforce or to do something different. I think this provides an interesting opportunity to really target marketing to younger people to get into the trades. The other half of that is one of the reasons it's been difficult to attract people to work in the trades is this can be hard work. It can be dirty, hot work. And that doesn't seem really attractive when you can make $12 an hour working the kiosk at T-Mobile in the mall. Well, the kiosks at T-Mobile in the mall aren't open anymore. And being able to wait tables or bus tables is not an option anymore for a lot of young people. And so this is another kind of potential opportunity to solve the skilled labor crisis that we've had for the last 30 years. It seems pretty clear that once we get people into the trades, a large number of them stick. They realize that there's meaningful work to be done that provides them with a middle-class lifestyle and the ability to have dignity in retirement. They realize they're able to get health benefits that maybe they won't get at some of these other jobs, and that's more important. So I think there is really some interesting additional sort of fallout from the COVID-19 crisis based on what our researchers are seeing. And this is kind of where we would put it. And so, as we think through the cornerstone topics around the economic headwinds and that sort of stuff, one of the things that sort of worsened what we thought was going to happen is just the number of this record wave of corporate bankruptcies here in the U.S. The cumulative count of U.S. companies with $1 billion or more in liabilities filing for Chapter 11 absolutely blew up to the point of 30 or so, about 45 of companies of that size going bankrupt within the first 30 weeks of the year, right? And so this is a huge impact on our overall economy. Other things that are interesting, ongoing, complexifying factors for our economic headwinds are things like election results and the accompanying tax policy changes, debt levels, a lot of additional government debt, a lot of additional consumer debt has come on as a result of this. Lack of clarity around future stimulus programs. We've been talking about an infrastructure bill for 4.5 years now, and not been able to get one really well put together. Return to mobility in cities is going to be a big driver when mass transit again reopens, when people are again returning to cities to work and live and for their entertainment. That'll be something that will help kind of improve the economic nature. Travel and just the impact of COVID-19 on travel, and so therefore on things like entertainment spending, dining spending, lodging spending, and airfare, and then the accompanying construction associated with those. All of those are, additional economic headwinds. And so, again, we still believe that there's an infrastructure deficit that is absolutely likely to increase, Andrew. I mean, that's a good get and absolutely true. Our infrastructure is definitely overdue for investment, but there's currently no comprehensive plan in place to overhaul it. So we've continued to stress this, and that's been something that the trades have done. That's been something that lobbying arms for the industry have done, individual contractors have done, but there's just been no really thoughtful approach to how we overhaul infrastructure. Until now, there are some interesting proposed stimulus program extensions that will have some push to infrastructure, right? And so the HEROES Act, which was the Democratic proposal, really drives a lot of increased support as well as some infrastructure programs. Now, Trump said he's not going to sign it. He's probably not going to be in a position to sign it in a month and a half. And so, I would assume some act like the HEROES Act will come out of the new Congress to move things forward. So is this still relevant? Are the economic headwinds, is that whole topic of economic headwinds still relevant? And our bottom line is yes, of course. No one can deny the impact of those economic headwinds. The recession was both more instantaneous and more severe than anyone could have predicted. We predicted a recession. We got the timing just about right. But the scale of it and just the nature of it kind of shutting off like a light switch was completely alien to our experience. The recovery, though, has been promising, right? And so originally when we mapped out the future based on the sort of scenarios we were seeing early in the COVID crisis, we thought that it might take 10, 12 years to recover the demand that we had lost. And we're becoming more and more convinced that this is really going to be a very nice V-shaped recession in terms of a really painful fall off, but really kind of a quick growth path back. And frankly, 2 years would be remarkably quick. If we recover back to pre-COVID levels by 2022, that would be on the order of 7 years faster than our recovery from the Great Recession, which was just as significant, but took a lot longer to recover from. So there are still some significant softness, particularly for small businesses. I was reading in the San Francisco Bay Area that 60% of small businesses that closed will not reopen. And that's a terrifying statistic, not just for sort of the economy broadly, but for all those people whose sort of life savings were put at risk in that. Infrastructure investment seemed like a no-brainer a year ago. It's even more so a no-brainer today. It's even more so a critical area of focus. And so the presumptively incoming Biden administration is looking beyond just transportation. So that's something that's really interesting about the proposals that we're hearing out of the folks that Biden has tapped to oversee infrastructure in his cabinet, is that the experience with ERA and the shovel-ready jobs led people to recognize that, if we focus on jobs that are transportation shovel-ready, we're going to end up doing a lot of asphalt patching and concrete work, and not a lot of the kind of projects that are really needed, right? It's a lot more of sort of patching work and repairs. And so again, there is going to be some sort of alternative procurement to speed work to market. But if we have divided government, and I know that is something that we still have yet to see, there's going to be a lot of collaboration required. And the question is compromise dead in the post-Trump era? I don't know how that shakes out. That's all still to be determined. And so more to come on that. But bottom line, yes, the economic headwinds, the need to invest in infrastructure, all still very relevant. The next sort of cornerstone topic was around technology, and we really kind of talked about this rapid change and evolution of tech. And the belief was that we were going to have to figure out how to adapt and adopt, or we might be left behind. And so some of the things that we thought were going to be key drivers there, things like offsite construction, 3D modeling and BIM, telematics, all that kind of stuff that we thought was really important stays important. And you know, the need to embrace technology and the ability to communicate and share information quickly at the time we thought was going to be of increasing importance. I think that's even more the case. Prefab and modularization. You know, we were talking about this a year ago. I think we expect to continue seeing this going forward. We're seeing a lot of investments by private equity funds, by construction firms in modularization, in offsite construction, sort of manufacturing of components. What's interesting is technology has really been the big winner of the COVID area. So virtualization of everything has led to reduced in-person project management requirements. This has created the opportunity for efficiency, the ability to run multiple meetings, to address multiple things in the same day, has improved the efficiency of project management. Now, the flip side again is the efficiency of labor in the field has gone down substantially. I was shared a study was shared with me by one of my clients in the building trades who did some time sampling of the labor out in the field, just looking at the impact of increased PPE requirements and social distancing and smaller crew sizes and all those sorts of COVID remediation efforts on labor productivity. And it ranged between about a 12 and a 20% decrease in productivity. So that was early in the shutdown and in the quarantine process. I think, you know, that is obviously going to improve as people's learning curves ramp up and as we figure out how to work safely. But it is something that we have to be thoughtful of and think about. Technology that allows for smaller crew sizes will be even more favored in this social distancing world. The flip side, though, is how does a virtual world impact construction demand? And so certain sectors like office, commercial, religious that don't tend to be strong national markets for the union finishing trades. They may be good in certain localities where there's high union density, but in general, they're not strong union finishing trades markets. Are likely going to be the ones that are most negatively impacted. So hopefully what that means is the markets in which union finishing trades operate are going to be less significantly impacted. And you look at some like education and healthcare, government and public safety, and you say there's probably going to be a change in how those services are delivered. And the implication of that is there may be extensive demand for renovations to ease cleaning, prevent pandemic spread. Some of that's going to be in mechanical systems, right? In filtration and things like that, which isn't really exciting to folks in the finishing trades, but some of it's going to be in coatings and flooring and things like that. I think that the days of carpet and soft surfaces in classrooms and offices may be a thing of the past, right? And that has an implication for the amount of renovation work that's going to be necessary. It's also going to require new ways of constructing as we proceed forward. So I think this still, again, technology is still a relevant topic. It's just got some additional nuances to it. The last cornerstone topic that we talked about was just traditional workforce shortages. And again, this is something that for over 20 years has been a primary concern, something that we've been worried about, and really especially around the generational shift of the construction workforce. And so as we look at sort of the composition of the industry by generation, you know, the need to attract younger millennial and Generation Z workers has absolutely been a key focus area for a lot of folks. And so when you think about that in the context of unemployment and you know, what this looks like for you know, the last several years, it became really difficult in a time of low unemployment generally to attract people to the building trades if it wasn't something that they were interested in doing or had a passion for. There were other options. Well, fast forward to kind of the past 12 months, you see up here in this upper right-hand corner, the unemployment rate spiked to 15%. It becomes much more easy to drive interest in the trades as a viable path for folks. And so this is really ties to the whole student debt issue. But again, it gets to that whole, am I going to spend all this money going off to college when I'm really not going off to college? I have a 20-year-old accounting major still living in my upstairs bedroom doing college from home. And frankly, if he wasn't studying accounting, which you have to have a college degree to do, he probably wouldn't still be doing that. It's not nearly the experience without the fraternity parties and the football games and that sort of stuff. The other key driver here is around union uncertainty. One of the things that came through loud and clear as a result of this pandemic and the initial surge in unemployment is, when you have employment insecurity in the U.S., that means you also have healthcare insecurity. And so the ability of the union finishing trades to provide a different approach for their members is something that I believe is going to be much more attractive. So we've seen this downward trend, and it continued, over the couple of years before we got to this point. But I think with improved perceptions, which is something that we're seeing of union membership in the broader society, for the first time, we're actually seeing perceptions of union membership improve over the last few years. And then, some of the impact of the current sort of economic upheaval and challenges may make it more interesting and may be what we need to reverse this trend in market share. Construction, particularly union construction, should be a much more attractive field to people. Again, if you were working in retail or restaurants, an apprenticeship sounds excellent right now. And this is work that can't be virtualized away. The next step that the corporate world will figure out quickly, if they're not already thinking about, is, hey, if I can have my people work from home, I can have people in other countries work from home too, right? So work that can't be virtualized away, that puts something tangible in place in the real world, leads to less likelihood of job loss. And again, the college issues, immigration policy changes are likely as well as a result of this new administration, which may open up an entirely new group to union finishing trades membership. And then again, movement out of certain high-cost urban centers can produce new demand for construction and a larger supply of available labor. And so as we talked about the 10 main challenges to address, the thing that I wanted to kind of answer is, have these challenges changed post-COVID? And I would say that, to the extent that they've changed, issues around healthcare costs and multi-employer pension reform may actually be changing in the favor of the union finishing trades, based on sort of a new recognition and realization of kind of healthcare insecurity, along with some changes in the administration that should be labor friendlier. The recession and mega projects impacts, I think that's an unchanged trend. I think that's an unchanged challenge. The short-term recessionary impacts, while they were more severe than expected, it looks like we're gonna bounce back quicker than expected as well. We don't expect any change in mega project demand. One of my taskings within FMI is to lead our thinking around mega projects, and so we expect that demand to still be there. Some of it may be deferred, but most of it will remain. And the sugar rush effect of mega projects, right, where it strips all the labor that's available in the area, is likely to continue as well. The union non-union gap narrowing, I'm not sure that changes in the near term, right? I do think that the wage gap continues to be narrower than people maybe perceive or believe. And so the more that can be done to kind of address fringes through improved policy, the better. But the other thing that we have to really be careful about is the non-union has been investing in growing their training capabilities. And so really keeping that skills gap is the key differentiator between the union finishing trades and non-union trades. And so we need to work to continue to grow that gap in skills. And then some of the challenges around IRAPs, now that may actually improve in the new administration. We'll see how that works out. And then the last one around, sort of generational trends. There were a few things that we thought we needed to address: mass talent exodus, changes in perceptions of skilled trades, and attractiveness to unions, or attractiveness of unions to the next generation. I think all of those move to the good. So I think we see some growth there and some opportunity for improvement there. So in summary, there are many geographies and sectors, frankly, that will be strong and thriving, but there will be others that may not recover for 5 or 10 years. So retail and office are in that mix. Religious will be in that mix probably, and certain urban centers will not recover for 5 to 10 years. I'm not quite ready to write off New York yet, but Chicago is certainly hurting, as well as San Francisco right now. It will be interesting to see if that trend of departing the big cities continues. I think for the contractors on the call, your strategic focus ought to be segment diversification, right? If you're in segments that are not as attractive right now, be thinking about how you can shift your focus. Geographic moves if they're needed, right? If you're in a geography that remains tough, I've actually had a couple of conversations with Chicago area clients looking at planting a geographic flag elsewhere to provide some diversity of opportunity. So those are offensive strategies, right? Going on the offense. Some defensive strategies you ought to be doing are staying close to your customers, and just providing being able to provide that consistent and well-trained source of labor. From a workforce focus standpoint, this is the best time in 50 years for trades recruiting. We just need to get our message right, get our messengers right. One of the great things at Finishing First was getting to lead one of the breakout sessions and hear some of the innovative things that people are doing to attract people of all demographic slices into the trades. Everybody from young coming right out of high school people to veterans to parents whose jobs went away, right? And I think this is the best time in 50 years to be recruiting people into the trades, into work that is tangible, that can't be put on a computer and therefore done away with. Technology focus, if you're a contractor or if you're a training center or something like that, using virtualization to minimize the stuff that's non-core, that's less important and less critical, and really using enabling technology to focus on maximizing the core functions of the business. And then the last piece here is just on economic focus. It's important to remember that recessions come and go, and in every recession, even in the Great Depression, new millionaires were born, new lasting and enduring organizations were created. And so focus on what you can control and just don't waste a lot of headspace or heartburn on what you can't. With that, I'm going to answer a couple questions from the chat. There's one really I can't answer, and this may be a bigger question, but thinking about the labor, the man hours lost as a result of 2008 and 2009, and what the recovery looked like, and likewise earlier recessions. I think that's a great question and certainly worth study and worth analysis. And some questions about tax policy and infrastructure policy. I think we're hearing a lot of talk, but we're not seeing a lot of concrete proposals yet. And so I would not say, for example, that it's a certainty that the incoming administration is going to raise taxes in a way that has a huge impact on most businesses. There are some proposals bouncing around out there, but nothing that has been sort of fully documented. Likewise with infrastructure plans, all of that's still really nebulous, although hopefully we'll get more clarity around that in the next 45 days. So with that, Anton, I'll turn it back to you, or we can open it up for other questions.
Well, Mike, if there's no other questions, I just want to thank you. There's a lot to unpack there, a lot of things to consider as we move forward, a lot of opportunities for us to take advantage of, some threats that we need to defend against, and those are some of the things that we're actively working on solutions for and programs for as we move forward. So I really want to thank you for the information. I really want to thank everybody for attending today as well. I know everybody's time is valuable. I appreciate you sharing some of your time with us. And a question just popped up in the chat about the slides being distributed. So we've recorded the presentation. The presentation will be available on the Finishing First website. So it's www.finishingfirstlmci.com. Go to the case studies and research section, and it'll be available there. So we will have them there for you. If they're not up today, they'll be up probably sometime tomorrow. So. Mike, really appreciate it. Everyone else, thanks for attending. Stay safe out there. You know, we still got a virus to contend with, so everybody stay safe, stay healthy, and we'll see you all again soon.
Thank you.
Thank you.
Thank you.
Thanks.